Today we'll be going over some crises on the horizon. These are the topics we'll be going over today. Again, none of these are investment advice. These are just my personal opinions. Please do your own research. So first up, we have the container shortage. So for example, the shipping cost from China to US is 10 times of US to China. This is because a lot of imports is being demanded from China to US, and there's not much um, exports from US back to China because a lot of people are not working, so they're not producing as much. But because they're not producing as much, then all those consumption that they need have to come from somewhere, and China is financing it so far. So let's go back into history to talk about what kind of started all this. So the four major shipping companies consolidated after 2008, the Great Recession, and from then on, they took up market share from 40% to 60% of the ocean cargo shipping business. And at the beginning of the pandemic, I'm not sure if this includes a lot of cargo ships. I'm sure this included a lot of the cruise ships. But what happened was, so they're for ships, these are huge investments, and um, as they get older, you can either repair them or you scrap them for the metal. And because the metal prices shot up because the mills weren't running because of COVID and more shutdowns, while China were trying to build a lot of hospitals, there was a huge surge in base metal prices. I think it's iron ore, that was a big one. And so what happened was, in order to conserve cash and keep the business going, a lot of old ships were scrapped in 2020. Majority to get iron to China, also because you're not really doing much. Like, there were a lot of shutdowns, and they were just trying. So shipping wasn't a big thing until kind of later on in the year. I think October, that's where it really shot up. And because of that, there's a lot of shortage in terms of ships available. Now, next up, there's a cap on shipping costs. So China has been capping shipping costs. So what happens is the prices weren't allowed to go up, even though it already went up a lot, but they capped it at a high point. And so what happens is the ship exporters are bidding against each other in order to get cargo containers, but the prices weren't allowed to go any higher. So even if the exporters were willing to pay more, there wasn't any available because of the price cap. Like the major shipping companies couldn't charge more. And this is a great example. Anytime you have a price ceiling, this could be rent, this could be minimum wage, or this could be container pricing. You will have a shortage because there's more demand than available supply. And what this is leading to, which will be discussed later, is other countries who exports are struggling to get shipping crates, where let's say Thailand is trying to ship rice, same with Vietnam, but they have to compete with China shipping stuff to US and other places. Leading from container shortage, let's talk about food shortage. So as mentioned multiple times on this channel, El Nino continues to impact agriculture production, where in the Americas, like US, Brazil, Argentina, you're seeing it's being too dry, a drought, where in China you were seeing floods in the northern part of China, where a majority of, I think it was wheat production. And one of the examples is for Brazil, one of the largest soybean exporter. Even though Brazil consumes themselves, they're able to produce more than they consume, so they export. it's actually lowered its tariffs on import because they have ran out uh, from in last year. So let's see what happens in March because the harvest is all done. They're just trying to see how much is actually there. So any agri reports or storage reports. And another example, Russia being one of the largest wheat exporters actually increased the export tariffs. So it's trying to reduce the export. It's trying um, the producers are able to do to keep more for themselves. And carrying on from the shipping container crisis, with containers, like a lot of them are being shipped back empty back to China because you don't have time to load it, wait for it to be filled with stuff to send back to China. And so what happens is you're wasting a lot of time because it's more profitable to just go, like unload your stuff from China and then ship it right back to China to go again, because the price is just it's so much more profitable to ship from China instead of to. And so the food exporters are struggling to bid for containers. For example, I think it was Thailand where one of the shipping companies or the exporters were saying normally they shipped like 7 to 8 ships to Los Angeles for rice. Now they're shipping 2 per week. So and finally, China has been increasing its imports on agri-foods, probably because they also experience weather issues with a lot of floods last year. And on top of that, they're trying to they mentioned they wanted to increase the production of pork to be more self-sufficient. Well, with pigs, what you need is a lot of corn or soybeans to feed them. So that also increased the consumption of it. Next up, let's talk about energy shortage or crisis. Obviously, like a big recent example is Texas, where you see the new how green energy, like Texas is, I think it's one of the biggest state in terms of wind energy production, and you saw how unreliable they are. And the U.S. new administration pursuit of green energy, they discourage new comers of fossil fuels, and I think they will try to more regulation or taxes on usage of fossil fuels. So I think this will drive a lot of the supply out of U.S. What happens is then U.S. will reverse from a net exporter of oil to a net importer. And from 2016, when Trump got elected, with all the fracking, what happened is a lot of the US investors have been burnt, because what happens is they invest a lot of money into these oil companies. Yes, they're generating oil, but what happens is because of the increased supply, it pushed oil prices much lower. So, and the companies only survived because of the historic low interest rates, which is from central bank, from the Fed. And so a lot of these investors have been burnt, and I don't think they're coming back because they don't have the money anymore, and also increased pressure from the new administration. And after we talked about the supply side, let's talk about demand side, where there's increasing wealth in third world countries. Now, why is this important? So when you think about increasing wealth in first world countries, they spend majority on additional wealth-wise. They spend on more services oriented. Obviously, if you're poorer, then you spend more of necessities. But if you think of third world countries, people will convert from walking to bicycle to motorbike to a vehicle. And let's be real, they're not purchasing a Tesla right out. And even just access to electricity, what's going to be cheaper and what's going to be more reliable? It's going to be fossil fuels. And so yes, we're trying to push for more green energy. Yes, I agree fossil fuels are bad, but I just don't think green energy is something that you can take over fossil fuels right away. Yes, we have to start somewhere, but the problem is who's going to build all those giant propellers for wind? Who's going to like what materials are you're going to use for those big solar panels, and how are you going to keep those reliably enough? And next up for supply, I think because of all the drill shutdowns to try to push oil prices higher, I think supply will recover a lot slower than demand can in the long run. Also, OPEC Plus, like oil is very political, and I think OPEC Plus, their attempt is to maintain, like, to avoid big fluctuation. They want to maintain the price slowly increasing. So we'll continue to see that. And honestly, I think like the key to solving this problem, like to avoid using so much fossil fuels, but also solve the higher costs and like and reliability, like, well, not green energy not being as reliable. I think nuclear would be the better route. Obviously, that means uranium, and I forgot what it's called, but they talked about a different element for nuclear energy as well. I think India has been putting a lot of R&D into that aspect. But again, I think nuclear, if you actually do the research, yes, obviously everyone only focus on the big explosions and the risk of radiation. But if you actually take a look of the data in terms of, number of death for nuclear, green energy, and oil, you'll realize green energy in terms of the per watt per energy output, it actually has one of the best efficiencies. So now that we've covered some fundamental economy issues, now let's talk about some financial market. So the debt crisis, the 40 years US Treasury bull market from the height of 1980s, most likely due to the inflation issues in 1970s, has ended, where I think the yields are not going down, like at least long-term wise, they're not going to their historic lows. Now, obviously, the Fed will have to try its best to keep it pressure lower, but I think long-term wise, the yields are going much, much higher. So the bond bubble has popped, and there's still a lot of air to come out. I think in the short term, the Fed has a dilemma where it's having trouble keeping long-term yields down, but keeping short-term yields up. And why do I say short-term yields up from going to negative? Is because when they pump a lot of money, it obviously doesn't go to individuals directly, unless if it's Congress passing stuff like stimulus bills, stimulus checks to like individuals, and then they sell the treasuries into open market, and then the big banks buy it up and then immediately turn around and sell it to the Fed. That's how you get money directly from the Fed to individuals. Otherwise, if it's just from the Fed to market, they buy and sell treasuries and give liquidity to the big banks. And well, the big banks don't want to lend that money out, but they're reluctant, at least, because these people, like people who can borrow, either like the return is too low for the risk in terms of credit. Like you don't want to do stuff like ninja, like lend to people who can't pay you back, and even if you are willing to, the return on it doesn't compensate your risk. So what happened is these guys are buying, instead of actually loaning it out and increase velocity, they're holding it and buying short-term treasuries on it, because they don't want to hold for a long term, but they're willing to hold 90-day, 30-day treasuries. And so what happens is that bits lower the short-term yield. So that's the kind of problem the Fed is having, um, to keep long-term yields lower, but keep short-term yields up. So pretty interesting there. But the big picture for the Fed is that they can't let yields rise, because what happens is there's too much debt. There's too much debt, and if yields continue to rise, you have people who can't, on variable rates, they can't, refinance. They can't afford higher rates, so they'll have to go bankrupt. And if yields continue to rise on the asset side, you have continuous devaluation of existing, bonds. So they don't want to let the asset bubble pop, nor they want to let, over leveraged companies to go bankrupt. So, and, the right thing obviously is let companies fail. Those over leverage, let them fail, let them go bankrupt. That's kind of how it really should work. But why do I think they won't let it happen is because just look at it. They had a chance. They had opportunities to let this whole thing fall, but they haven't. From 2018, they pumped their balance sheet all the way up to 4.5 trillion. They mentioned they'll let interest rate normalize. They mentioned they'll shrink their balance sheet. They got to what? They pumped it up to, I think, 1.25%, and a balance sheet down to 3.8 trillion before having to ramp up again before COVID. And now they're at like 7.5 trillion for balance sheet, and interest rate is back at 0. So if they wanted to do the right thing, they would have. I don't think they will, until they have to, which is when I think inflation gets out of hand and they can't hide it anymore. That's when the game's over. So until then, I think they will continue printing. I think they will continue to hold interest rate low. And that's the dilemma. You can't keep the yield lower without more inflation, because you're in order to keep yields low, they print money and they buy those treasuries, and with more demand they push the yield lower. But when you have more money printed, there's higher inflation and inflation expectation. And because of inflation expectation, the buyer of other buyers of the bonds want higher yield, because if I know inflation is going to be 2%, why am I holding a bond yielding like 1.5, right? I know I'm losing money. That makes no sense. So I want higher return. And finally, the other side is the credit rating is in question. Like, let's be real, US government is insolvent. How the hell is it still having a AAA? Obviously you have from 2008, I forgot who, I think maybe it was Moody's or S&P, I forgot who someone downgraded US treasuries, and then they got shit for it afterwards. It was just lawsuits of so I think the rating agencies have learned the lesson to not fuck with US treasuries. And so that's the national debt wise, but corporate debt, like a lot of companies are not having profits, or not as high as they had before, but they're not getting downgraded. Like a lot of these zombie companies are surviving only because of all the government loans and stuff. So there's still a massive downgrading I'm expecting. And when you downgrade credit, the bond price really gets impacted. So that also leads to the holders of those securities, and that's again I think why the credit agency have been reluctant to do so, because they're being told, hey, you don't want to trigger this. Now let's talk about the stock market overvaluation. So I think it's pretty, I'm pretty sure everyone knows this, or should at least. It's so overvalued that there has been, I think some people, or some anchors on CNBC have said like, oh, we know it's a bubble. We know eventually it's gonna pop, but it keeps going up, so you have to be in. That's that's pretty much all you really need to know. But of course, if you look at economy, it's not recovering to the point that it was before pre-COVID, because it's very simple. There are businesses who are permanently damaged, and the only reason there has been this kind of a bit of recovery is because of the massive printing of money to keep them alive, to keep while shutting down the whole economy. So obviously that's pretty apparent. Cash on the sidelines, historic low. I think it was 3% last time I checked. Margin debt at historic high in terms of absolute value, but in terms of market cap is near historic high. I think it's like 2.1% for the New York Stock Exchange, when I think either it was dot-com bubble or the housing 2008. I think it was at 2.5. So we're there. PE ratio, I've talked about this before, is through 2 standard deviation from the mean. It was at 3rd standard deviation in dot-com bubble and 1st in 2008. So meaning in terms just PE ratio wise, we've passed 2008. We haven't got to dot-com bubble, but like, do you want to gamble on your life savings on it? I wouldn't. Retail investors who had like no idea about investing, like for example, like Uber drivers or just kids who had no idea what investing is. They were just dumping their money into whatever is hot, like momentum stocks. I'm not saying regular retail investors should not get involved in investing. I am for that. Like, yes, everyone should learn about investing and financial literacy, but I don't think they have obtained the sufficient knowledge to make those decisions, and they think they know what they're doing just because they're on the run of momentum. And I think that is going to burn them. We've seen this played out before multiple times. The retail investors get too bullish at the end of a bull market, while the intelligent investor stays out of it, and once the whole thing blows up, they just buy it all back when these guys go bankrupt and they can't afford it, especially with leverage. So don't mistake leverage for genius. And you have crowd movement from platform like Reddit, and the great example is GameStop. Like, yes, theoretically, if everyone held for GameStop, if everyone held their shares and not sell, yes, the short squeeze would still have happened. They would have been driven out, and the stock prices would not fall so catastrophically. It can maintain a certain level. Obviously, eventually the earnings comes out, you see like cash flows, like the company isn't doing well, but at least it wouldn't crash so fast like that. But somebody broke the line. Like, all my idea is, a lot of hedge funds jumped on it on the long side, and then they sold as these retail investors are going in. So think about someone like, obviously pre-trading it got up to 500. I think during trading it didn't, like, so only got up to 400 something. Imagine some guy because someone who sold it, or someone bought at that, someone sold at that price. Imagine someone buying at 400 bucks. Now they're down at 40. It's over. I think it's going a lot lower too, but that's just an example where, just crowd movement, and these guys have no understanding. Great job on the short squeeze, but you have to sell. That's the problem, because the underlying company isn't is a problem. Go back to my previous videos. I've talked about this already. So very few companies on the S&P 500 is actually generating profits. Obviously, majority of your FANGs, but a lot of these companies are being kept up just because low interest rate and a lot of federal fiscal support. Now let's talk about the currency crisis. So countries around the world are competing to devalue their currencies. I think that's one of the reasons why the US dollar has been, held strong, because everyone else has this false idea that, we should devalue our currency. This is accompanied by historic low interest rates. Like just look at Japan, ECB, with their negative rate policy, even though the ECB has actually seen their members have seen their national debt yields turning positive. You look at Italy, Germany, look at their long-term national debt, the yield have actually turned positive. So again, that goes back to inflation expectation, which we'll discuss later. So what does money printing and historic low interest rate does? It steals purchasing power from savers, and they give it to whoever they give it to. And what this does is it rewards borrowers, people who take on extra leverage, take on extra risk, and it hurts savers. And this always benefits the rich and hurt the poor, because the rich are usually people who can and who have better credits to borrow more money, and there are those who have financial assets that benefits from more people borrowing money to bid up asset prices, while poor people who work and unable to save as much still have to experience their savings being devalued by government. And an example of currency crisis, we can look at Zimbabwe or Venezuela, where when you keep printing, or Weimar Republic, like the examples goes on and on. When you print a lot of money, what happens, because the stuff you can buy doesn't change. So if you have more these fiat notes chasing the same amount of goods, the prices have to go up. Yes, obviously there's a lag. And that's because of you got to go through banking and money creation and etc. But eventually that happens, and how long, right? So the central banks will have to come to a point where they decide, do they continue trying to save financial asset prices, or they let it fall and save the currency instead. So on this channel, we've talked about inflation for a long time. The writing was clearly on the wall once you've understand what the government and central bank is doing. In my eyes, come on, the central bank is pretty much part of the government, just financing the deficits with money printing. And what I'm concerned, we can already see inflation. Just look at commodity prices. Look, copper's at $4. We'll talk about that later. But the concern is how long until they stop this? How long until they give up? And stagflation is really the biggest concern here. And the recipe for it, we have it. We have government budget deficits where its revenue is less than its expenses, and it's increasing. Okay, we're not collecting taxes, and we continue to start new programs. We're giving money away left and right. There's massive money printing from central bank, majority to finance that, and also buying up the debt market to make sure financial assets don't crash. And finally, we have it now, it's starting, the supply shortage from container shortage and goods not being able to go to where they want to, and so supply shortage is here, and we will see that. Like we already see it. Like just check your grocery bill, check it, meat that you normally buy, check it, any like fruits that you normally buy, and see how much prices have increased, and it's just getting started. And yeah, we go back to the theme that central banks and government are unwilling to let this whole thing collapse. I'm willing to let over-leveraged companies go bankrupt. I'm willing to admit that what they've been doing is wrong with artificial low interest rates and money printing. It doesn't work. It just kicks the can down the road. They're hiding the truth from the public using CPIs. Like, how do you have like a below 2% CPI when they factor stuff like, oh, rent is remain lower, so it drags the whole thing down. Before gas prices were really low, so that helped them as well. But there's a lot of manipulation in CPIs. I would just look at commodity prices for stuff that you actually use and consume, and just look at the supermarket prices. I just went shopping yesterday, and my bill went up by quite a bit. And so inflation is here. It's not coming anymore. It's here, but it's just getting started. Finally, I thought I obviously give some commodities update. So oil has since tracked back from $60 as expected. I like there was a lot of pressure around $60. So no idea how long it'll take. But once it's done consolidating, I don't see much pressure moving up to $80. Copper is now $4. That's crazy, and I think it could make a all-time high. In the future, I'm very confident about that. So the whole commodity index is moving up, except for precious metals, and I think a big part of that is in terms of the marginal speculators. So these are people who usually jump on it earlier for inflation, are going into crypto because they're seeing it's being bid up. Like, oh, I learned stuff about inflation, and hey, but crypto is going up, so I'll go into that because gold is going down. So maybe crypto is the new gold. I will go into cryptos instead. But I think the real inflation concerns aren't here yet, and the smart money have yet to protect themselves for that risk. And if you're looking at maybe the COMEX to have some issues, I think watch the March contract for silver, with the first notice day being this Friday, and then the April contract for gold. So those would be your kind of indications. But I think what happens is once inflation concern is really here for the smart money, and when they start bidding up, like if you actually look at physical, like the premiums are so much higher than these spot prices. I think once the smart money moves in, then you'll see precious metals move up, and I think the mania from crypto will fade away.